Hello, if you're new to the channel, thanks for coming over and welcome, and if you're returning, welcome back. This video will give you information on consumer protection in relation to personal finance. This video will include the function, role and responsibilities of the Financial Conduct Authority, the Financial Ombudsman Service, the Financial Services Compensation Scheme and consumer credit legislation. The Office of Fair Trading was in control of protecting consumer interests in the UK, but this is now the responsibility of the FCA. The FCA, otherwise known as the Financial Conduct Authority, is an independent body and they report to the HM Treasury, which is the government's Economic and Finance Ministry. Since April 2013, banks, building societies and credit unions have been regulated by the FCA. The FCA aim to ensure that consumers are treated fairly. The FCA's aim is to make financial markets work well so that consumers have a fair deal and that consumers have access to the financial services they need. The FCA has an objective to ensure that the relevant markets function well and that consumers have a range of products and services. The FCA will make visits to financial providers, monitor the transactions, and at times contact consumers directly, as well as monitor the market and the economy. The FCA can ask financial providers to explain fees and decisions made that impact on consumers. Here's another article to do with the FCA. So what they found here with the buy now, pay later firms, so where people are purchasing items but they would pay for it at a later date, they found that for some of these firms, the terms and conditions that had been drafted weren't very clear. So customers were still paying their installments for the given good that they'd purchased, and they were paying for the installments when they didn't need to, or they were charged late payment fees after a loan agreement should have ended. The FCA also have power to impose fines on providers where they have broken rules. Now, the FCA do not handle any individual complaints. That is to do with the Financial Ombudsman Service. The Financial Ombudsman Service is otherwise known as the FOS. It's an independent body that was set up by Parliament. It's a free service that is used to settle complaints between customers and a financial provider. A financial provider such as a bank, building society, insurance company, for example. Customers will need to complain to the financial provider first and follow their complaints procedure. So they need to complain to their bank or their building society first. And if they're still not satisfied, then and only then will they contact the Financial Ombudsman Service. You cannot complain to the FOS without complaining to your financial provider first. The FOS resolve disputes fairly. They do not take sides. They will consider both sides. And if they think that the bank has behaved fairly, then they will explain to the customer why. If they think that the bank has acted incorrectly and the customer has lost money as a result, they will order them to put things right. Financial Ombudsman Service cannot fine businesses. Financial Services Compensation Scheme, otherwise known as the FSCS, is an independent body, so they're independent of the government and the financial services industry. It's a free service and they were set up in the year 2000. If a financial provider fails, if they're in financial trouble, for example, then the consumer that has deposits, such as savings accounts and bank accounts, with that given financial provider is protected up to the value of £85,000 per person per provider for the money that they hold there. So if Halima has £85,000 saved in a building society savings account and that building society were to fail, then the money that she has saved there is protected. Anything above the £85,000 is not protected. Now, for mortgages and investments, the level is different. They're covered up to the value of £50,000. But the fact that the FSCS offer this, it helps to create some kind of stability within the economy. So if a bank or building society were to fail, for example, then it gives some kind of assurance to consumers that they don't need to panic about the money that they have with that financial provider. Next is the consumer credit legislation. The Consumer Credit Act of 1974 gives consumers protection on credit card purchases and hire agreements. It protects consumers if they enter into an agreement about a loan or hire agreement. It also covers the credit limits and things like the cooling off period. If you haven't heard of a cooling off period, it's a period of time where consumers are given the right to cancel their contract within 14 days of entering into a financial agreement. So this falls under the consumer credit legislation, as well as information about interest rates and the access consumers have to their credit file. This brings an end to the video. Thank you for watching this video, and good luck with your studies.